Welcome to Voyage Daily Tech, the most important news personalized for you every day, supported by Voyage.com.
So, what's on the docket today? We've got 5 major tech stories for you. We're starting with a full-blown corporate mania as dozens of companies go on a risky, high-stakes Bitcoin buying spree. Then, we'll shift gears to Meta's controversial decision to finally monetize WhatsApp with ads, breaking a foundational promise to its billions of users. From there, we're heading to Europe to look at its multi-billion-dollar gamble to build its own sovereign AI. After that, it's back to the US for a look at the new Trump Mobile, a pricey phone plan that seems to be selling a political brand more than technology, and we'll wrap things up with Warner Brothers, Discovery's drastic plan to literally tear itself in two, all to escape a mountain of debt. Let's start with a single statistic that might just change your entire perspective on corporate finance. A company that started buying Bitcoin just a few years ago has seen its stock explode by more than 3,000%. And now it seems everyone wants a piece of the action. Publicly traded companies are on an unprecedented crypto buying spree, and the numbers are staggering. We're talking about 61 companies, including one founded by Donald Trump, now ditching traditional cash reserves to load up on Bitcoin. These copycats have doubled their crypto holdings in just the last 2 months, collectively holding just under 100,000 Bitcoin. It's all an attempt to chase the historic success of MicroStrategy, a software firm that now holds over $63 billion in the cryptocurrency, and the new players are just as massive. A joint venture involving SoftBank and Tether is launching a $3.6 billion fund with the sole purpose of acquiring Bitcoin. Trump Media Technology Group just raised $2.5 billion to do the same. So why now? One expert suggests some firms might be trying to get political attention, noting Donald Trump has signaled his interest in the industry. But one executive put it more bluntly, saying if the market is rewarding companies for holding digital assets, then it's their fiduciary duty to do it. This is where the situation takes a more complex turn. The strategy is a high wire act. One report estimates that if Bitcoin's price falls below $90,000, half of these corporate Bitcoin treasuries would instantly be underwater, potentially triggering a liquidity crisis. It's a mania playing out in corporate boardrooms, a high-stakes bet on the future of money, and as one analyst warned, whenever there's a mania like this, there will be some really, really big winners and some really big losers. From one high-stakes corporate gamble to another, let's turn to Meta. It took 11 years and a $19 billion price tag, but the company's finally doing the one thing WhatsApp's founders swore would never happen. Ads are officially coming to your WhatsApp. This isn't just a small change, it's a complete reversal. The app's founders, Yan Koum and Brian Acton, were so famously against advertising that they left Facebook after reportedly clashing with executives over this very issue. For years, the platform remained a commercial-free sanctuary. Well, not anymore. Mark Zuckerberg is now calling WhatsApp the next chapter in Meta's history, and that chapter is all about money. The company is flipping the switch on its massive user base, over 3 billion people worldwide, including more than 100 million in the United States alone. The new ads will appear in the Updates tab, separate from your personal chats, alongside features that vanish after 24 hours, and the monetization doesn't stop there. Meta is also leveraging its channels feature, letting organizations pay to boost their visibility and even charge users monthly subscription fees, of which Meta eventually plans to take a 10% cut. What really puts this move under a microscope, though, is the timing. This entire monetization push is happening while Meta is in the middle of a high-profile antitrust case with the Federal Trade Commissioner lawsuit that directly challenges its blockbuster acquisitions of WhatsApp and Instagram in the first place. So, after more than a decade of holding out, Meta is turning one of the world's largest communication platforms into a new revenue machine, all while regulators question if they should have been allowed to own it at all. It really makes you wonder, what does this mean for the future of our private conversations? Speaking of the immense power of American tech giants, a battle for digital independence is brewing across the Atlantic. A single US tech company spends between $10 billion and $15 billion on infrastructure every quarter. So when Europe announced a $20 billion plan to catch up, one expert had a simple and frankly brutal question: who in Europe can afford that exactly? That one quote reveals the absolute chasm at the heart of a new global tech battle. The continent's leaders are waking up to a stark reality. Their digital future is almost entirely run by Microsoft, Amazon, and Google. Now, they're scrambling to break free, with the French president calling it our fight for sovereignty. And who's stoking the flames? Actually, it's the CEO of American chip giant Nvidia, Jensen Huang. He's been touring Europe, pitching a concept called sovereign AI, the idea that every nation needs to own and control its own artificial intelligence. His message is a direct challenge. Europe needs to move into AI quickly. The call to arms is being answered. The UK just announced £1 billion to scale up its computing power. The European Union is planning 4 AI gigafactories. And France's own AI champion, Mistral, is partnering with Nvidia to build a massive new data center, starting with 18,000 of its latest chips. However, there's a fascinating paradox at the heart of this race. While Europe scrambles to build its own tech champions, they're still relying on Nvidia's American-made chips to do it. And all this new infrastructure needs a colossal amount of power, something Europe is already struggling with. It all boils down to one gigantic dream, but with a price tag that seems almost impossible to pay. This isn't just about building technology. It's a high-stakes gamble for digital independence. The question is, can a continent truly buy back its future one chip at a time? This blend of technology and political identity isn't just playing out on a continental scale. Back in the US, a major political figure is launching his own tech brand. A new mobile plan just launched that costs nearly double its top competitors. The company behind it, the Trump Organization, the new service is called Trump Mobile, and it's rolling out with a $499 smartphone called the Tone, featuring a gold-colored case etched with an American flag. The monthly plan will run you $47.45. For comparison, a similar unlimited plan from Verizon's budget service costs just $25. So what's behind the price? It's all in the branding. The plan is officially named the 47 plan, and the monthly price is $47.45, both, references to Donald Trump's potential service as the 47th president. The real twist, however, is buried in the company's own disclosures. According to its website, Trump Mobile, its products and services are not designed, developed, manufactured, distributed, or sold by the Trump Organization. This is a licensing deal, a business model that reportedly earned Trump more than $8 million in 2024 alone. And the story takes another odd turn from there. The company boasts of a US-based customer service call center, but when a representative was asked where that center was located, they declined to answer, citing security reasons. So you have a high-price phone plan built on a political brand, operated through a licensing deal with a secret support center. This all begs the question, are you buying a phone service or are you buying the brand itself? While a new brand enters the tech world, one of the biggest names in entertainment, Warner Brothers Discovery, is literally tearing itself in two just to stay afloat. The company just got the green light from its investors to cleave itself into separate businesses, and the reason for it is a staggering $37 billion mountain of debt. This entire corporate earthquake is happening because of the financial fallout from the merger of Warner Media and Discovery. And what really brought this to a head was the next development. Major credit rating agencies like Fitch, Moody's, and S&P Global have all just downgraded that massive debt to junk status. That's a rating that triggers forced selling from major funds. So what's the escape plan? It's a corporate split that amounts to a high-stakes gamble. The company will be divided into 2 new entities. One half gets the crown jewels, the Warner Brothers Studios and the HBO Max streaming service. The other half gets the fading cable networks and the lion's share of that $37 billion debt. If that sounds like a raw deal for one side, you're not alone. The plan is designed to give the streaming and studio business more flexibility to compete, unburdened by debt, but some investors are now sounding the alarm, concerned they'll be left holding unsecured bonds tied directly to the declining cable business, potentially leaving them empty-handed if it fails. Incredibly, bondholders just overwhelmingly approved this plan, with some groups voting up to 99% in favor. So you have to ask, is Warner Brothers Discovery performing a brilliant corporate rescue, or is it creating a lifeboat for its streaming future by cutting the cable division loose to sink?
That's it for today on Voyage Daily Tech. Follow, share, and stay tuned for daily updates coming your way tomorrow.